any remuneration paid by an employer to his employee in consideration for his service is called salary. Allowances is a monetary benefit provided by the employer to his employees to meet specific purpose. Allowance allowed by the government for posting the employee outside India, it is fully exempted, that is foreign allowance. Hello everyone, I am Arun Kumar, lecturer in Department of Commerce and Management, Vidhyaashram First Grade College, the Temple of Excellence, Mysuru. Dear students, welcome to this new session on unit number 2, that is income from salary. So in this particular unit, you are going to study about what is salary and how to compute the income from salary, and you're also going to learn about what are the deductions available under income from salary and some benefits like allowances and perquisites with respect to salary. So before getting into solving the problem or before getting to how to compute the income from salary of a particular person or of an individual person, first we have to understand what is the meaning of salary, right? So if you understand the meaning of salary, then you will get to know how to compute income from salary of an individual person. So first we have to understand the meaning of salary. So the meaning of salary is defined under section 17 subsection 1 of Income Tax Act 1961. So the section says any remuneration paid by an employer, any remuneration paid by an employer to his employee in consideration for his service is called salary. Yes. So any remuneration paid by the employer to his employee in consideration of his service is called salary. So for example, you are working for a company, okay, and company is providing you the salary. So there is a consideration, there is an understanding between the company and you. So what is that understanding? You are supposed to do some work for the company and company will pay you some money to you. That is the understanding between you and the company. So whatever the amount they are paying you for the work done by you, that is called what? Salary. So any remuneration paid by the employer to his employee in consideration of services is called salary. So any amount paid by the company or by the employer to his employee in consideration of services, that is for the services rendered, it is called salary. So salary means remuneration or any amount received by the employee from an employer in return for work performance is known as salary. Yes. So if you are an employee, if you are serving a particular company, then the company is called the employer. So if any amount paid by the company for the service rendered by you, any amount, remuneration or any amount paid by the company for the service rendered by you, that is called salary. And it is also includes monetary and non-monetary benefits or facilities provided by the employer to his employees. Yes, salary, it includes the monetary benefit, that is the remuneration paid by the employer to the employee for the service rendered by the employee. And the word salary also includes, what it includes? It also includes the monetary and non-monetary benefits provided by the employer to his employees. For example, they provide car facility, right? They provide rent-free accommodation, that is quarters facility, right? They provide uniform allowances. So these are all the other allowances and facilities are also to be considered as salary for the purpose of computation of income from salary with respect to income tax. Okay, so I hope all of you understood the meaning of salary. Moving further, allowances. So what is this allowances? So allowances is defined under section 10 subsection 14 intersection 1 of Income Tax Act of 1961. So what the section says? Allowances is a monetary benefit. Allowances is a monetary benefit provided by the employer to his employees to meet specific purpose. Allowances is a monetary benefit provided by the employer to its employers or to his employees to meet specific purpose. For example, dearness allowances, traveling allowances, uniform allowances, etc. So any facility provided in cash. For every month, the employer will be giving 2000 rupees for traveling allowances. So 2000 rupees in cash is giving. That is called allowances. So any facility provided by the employer to the employee in cash, by providing cash, that is called allowances. For meeting specific purpose is nothing but for traveling purpose, for washing the uniform, or for accommodation purpose. For specific purpose, employer will be giving some amount to the employee, that is called allowances. Okay. Types of allowances. Yes, in allowances also we have different types. So which are those different types? Fully taxable allowances, partly taxable and partly exempted allowances, and fully exempted allowances. So what is this fully taxable allowances? That means whatever the amount provided, whether he provides 2000, 2000 is also taxable. If he provide 10,000, 10,000 is also taxable. Then what is this partly taxable and partly exempted allowances? Partly taxable and partly exempted allowances is nothing but if he is providing 10,000 rupees, in 10,000 some part is taxable, some part is exempted. For example, uniform allowances. He provided 1,000 but you spent only 500 rupees for uniform, for washing your uniform. So 500 rupees you used, that 500 is exempt. The remaining still you have 500 rupees, that 500 is taxable. So those kind of allowances are called partly taxable and partly exempted. Next, fully exempted allowances. So what is this fully exempted allowances? Few allowances are fully exempted. Need not to pay tax on those allowances. Even you are receiving the amount of 10,000 rupees, a specific allowance, that is fully exempted. So I will explain you in the later stage which are those allowances which are fully exempted. So first look into fully taxable allowances. So which are the allowances are fully taxable? So dearness allowances. So whatever the amount you received, like whether you received 10,000 rupees, that is fully taxable. Dearness pay, it is also fully taxable. Fixed medical allowances. So if any medical allowances is received, it is also fully taxable. That is fixed medical allowances. Next, the tiffin allowances. So 50 rupees per day for 300 days in a year. It is also fully taxable, which is tiffin allowances. Next, non-practicing allowances. So if any non-practicing allowances is given to an employee, it is also exempted from tax. Next, hill allowances. Hill allowances is also fully taxable. Next, warden allowances or hostel allowances. Next, deputation allowances, overtime allowances, family allowances, project allowances, marriage allowances, and rural allowance. So these are the items or the allowance which are fully taxable allowances. Next, partially exempted allowances. That means partially exempted, partially taxable. House rent allowances. Yes, house rent allowances is partly taxable and partly exempted allowances. Next, traveling allowances. Yes, for example, the employer provided you 2,000 rupees for the purpose of traveling. Okay, employer provided 2,000 rupees for the purpose of traveling. But how much you spent? You spent only 1,500 rupees. So you spent only 1,500 rupees, but employer provided you 2,000 rupees. So the remaining 500 rupees. So this 500 rupees is taxable. So 1,500 exempted because you used 1,500. This 500 is taxable because you didn't use that 500 rupees. So traveling allowances is also partly taxable, partly exempted. Next, conveyance allowance, helper allowance, uniform allowance, children education allowance. Yes, children education allowance exempt up to rupees 100 per month per child, maximum of 2 children. Okay. For example, in problem, you'll give like the employer will provide 200 rupees per child for 2 children, the employer provides 200 rupees per child for 2 children. But according to the Act, what is the exemption limit? The exemption limit is 100 per child, maximum of 2 children. Okay, so under Income Tax Authority or Income Tax Act, we have some exemptions. So we are supposed to follow those exemptions. Next, children hostel allowances, that is exempt up to 300 per month per child, maximum of 2 children. Next, out of station allowance and modified field area allowance. Next, fully exempted allowances. So which are the items which are fully exempted? So foreign allowance, yes, foreign allowance is fully exempted, that will not be taxed. So allowance allowed by the government for posting the employee in outside India. Yes, allowance allowed by the government for posting the employee outside India, it is fully exempted, that is foreign allowance. The next, allowance to High Court or Supreme Court judge. Allowance to High Court and Supreme Court judges, it is fully exempted, it is not taxable. Allowance from UNO, if you are receiving any allowance from UNO, it is also fully exempted. Next, allowance given to chairman of member of UPSC. Yes, any allowance given to chairman of member of UPSC, it is also exempted from tax, that is, it is fully exempted allowance. It is an allowance, but it is a fully exempted allowance. We will not be taking for taxable purposes. So this is all about allowances. So in allowances, mainly we have 3 types of allowances, that is fully taxable, partly taxable and fully exempted allowances. And these are all the fully taxable allowances, and these are all the partly taxable and partly exempted allowances, and these are all the fully exempted allowances. Moving further, perk visits. Okay, what is this perk visits? Perk visits is nothing but any facility provided by the employer to the employee in kind. In kind. So any facility provided by the employer to the employee in kind is called perk visits. So perk visits are the given by the employer to his employee. Yes, perk visits are given by the employer to the employee. It is non-cash benefit. Yes, perk visits are non-cash benefits. It is given to a positioned employee. Positioned employee is nothing but the employee is working in a company. So perk visits are given by the employer to his employee. It is a non-cash benefit. For example, car facility. Here the employer is providing the facility, not the cash. You can use the car, right? You can use the car, but he is not providing the cash. So using of services or the facilities provided by the employer is called perk visits. So perk visits are the non-monetary benefits received by the employee from the employer. Yes, perk visits are the non-monetary benefits received by the employee from the employer. Perk visits denote a personal advantage. Yes, so it's a personal advantage for each and every employee, and the employer is going to provide those advantages. If it is given in kind, it should be capable of being measured in terms of money. Yes, in case if they provide car services, so what is the total worth, what is the value of that service, that should be capable of measuring in terms of money. For example, telephone bill paid. So what is the amount paid by the employer? 200 rupees. So you can easily measure 200 rupees, right? So if it is given in kind, it should be capable of being measured in terms of money. For example, providing house, providing car facility, providing laptop, or providing tea or coffee, or providing snacks to the employees. These are all the examples for perk visit. Taxable perk visit, that means the facilities which are provided by the employer to the employee which are taxable. So first one is facility of rent-free house or house for concessional rent. Yes, if rent-free house, rent-free accommodation is provided by the employer, then it is a perk visit and it is taxable. Next, payment of life insurance premium of the employee. So what will happen? The employer is going to pay the LIC premium of the employee. He is not providing cash to the employee, but on behalf of employee, the employer is paying the LIC premium. So it is also a taxable perquisite. Next, payments of employees' obligation, that is electricity bill, telephone bill. So here the employee is supposed to pay electricity bill and telephone bill, but on behalf of employee, the employer is going to pay. That is also a taxable perquisite. Next, interest-free concessional loan provided by the employer. Interest-free concessional loan provided by the employer. It is also fully taxable perquisite. Taxable only when it crosses 20,000 rupees. Yes, interest-free loan which is given by the employer, if it crosses 20,000 rupees, then it is taxable. It is not taxable when loan is provided for the specified diseases like cancer, AIDS, etc. So any loan is given for the purpose of any diseases like cancer or AIDS, on that loan it is not taxable. Next, holiday enjoyment taxable, free food, gifts, club expenses, expenses charged to credit card and transfer of movable assets. So these are all the taxable perquisites. That means if any kind of this facility is provided by the employer, then it is taxable in the hands of employee. Tax-free perquisites, that means no tax at all on those perquisites, on those facilities. So which are those? Reimbursement of medical expenses. If you are receiving back, if they are refunding your medical expenses, then it is not taxable. Next, refreshment is tax-free perquisites. Recreational facility, telephone facility, personal accident insurance, family planning, sale of assets, rent-free house, conveyance facility, leave travel concession, free holiday trip, and interest-free loan. So these are all the items which are tax-free perquisites. It's nothing but there is no tax on these kind of facilities which are provided by your employer. Next, provident fund. This is the main important topic which you have to understand, because this question will be asked in your main exam for 15 marks. So compulsory question for 15 marks in your main exam. So you have to give more importance to this particular topic, that is provident fund. So what is this provident fund? It is a fund maintained for the future benefits. It is a fund maintained for the future benefits. Yes, you are going to maintain some fund which is going to benefit in future, in your old age. So the both employer and employee contributing sum of money for future benefits of the employees. So here both the employer and the employee are going to contribute some money for the benefit, for the future benefit of the employee. So if you are working as an employee, then some part of your salary and some money which is given or deposited by your employer will be deposited in account for your future benefit. Worker must contribute a specific portion of his salary and an equal sum will be contributed by the employer. Yes, worker is nothing but employee. Employee is supposed to contribute a specific percentage like 12% of his basic salary. The employee is supposed to contribute 12% of his basic salary. That is the minimum contribution what I am telling. So 12% of his basic salary towards the provident fund, and the employer will also contribute the same percentage of amount towards the provident fund account of an employee. The employer deducting some amount from the employee's salary and credited to this fund at a certain rate of salary for a future benefits. Yes, what the employer will do? The employer is going to deduct the 12% of provident from the employee's salary and credit it to the particular provident fund scheme for the future benefit of the employee. The employer also makes his own contribution to this fund. Yes, he is going to deduct, is going to cut some percentage from the employee salary, and also he is going to contribute some portion of amount towards the provident fund account of a particular employee for the future benefit. So this is called provident fund. So it's a kind of account opened by the employer to facilitate or to benefit the employee in future. So that is called provident fund. For that, employee and the employer both are going to contribute on monthly basis. And employee is supposed to contribute minimum of 12% of his basic salary towards the RPF, that is provident fund account, and the employer is also going to contribute the same percentage of amount towards the provident fund scheme to benefit the employee in future. So in this provident fund, we have 4 types. So which are those 4 types? Statutory provident fund, recognized provident fund, unrecognized provident fund, and public provident fund. So totally we have 4 types: statutory, recognized, unrecognized, and public. So let us look into one by one. The first one, statutory provident fund. So what is this statutory provident fund? This provident fund scheme is mainly intended for government departments, educational institutions, and university employees. Yes, statutory provident fund is mainly for government employees, education institutions, and university employees. So here, statutory provident fund, this scheme or this type of provident fund is given or maintained by education institutions, government departments, and university employees. Next, recognized provident fund. It is a fund to which Provident Fund Act 1952 applies. Under these schemes, this provident fund can be opted voluntarily. Any organization which exceeds the number of employees more than 20 persons, such organizations can opt the recognized provident fund. The scheme is to be approved by the Commissioner of Income Tax. It can also avail the tax benefits. Yes, recognized provident fund, it is also a kind of provident fund which can be opted by any kind of industries, any kind of organizations where the number of employees are more than 20. And here under recognized provident fund, there is a tax benefit, and the organization is supposed to go and approach the tax authority for the tax benefit of the employee for contributing the amount towards the recognized provident fund. So where more than 20 employees are there, that companies can opt for this recognized provident fund. Next one, unrecognized provident fund. It is that provident fund which is neither statutory nor recognized. Yes, it is not a kind of statutory provident fund and a recognized provident fund. It is unrecognized provident fund. Any institutions or organizations can maintain this fund. Yes, unrecognized provident fund, any institutions can maintain, but it is not like recognized provident fund and statutory provident fund, and the rules and regulations for this unorganized, that is unrecognized provident fund is completely different. Okay, so the rules and regulations for this unrecognized provident fund is completely different compared to statutory provident fund and the recognized provident fund. The fourth one, public provident fund. So what is this public provident fund? So it is also called PPF. So PPF was started from 1/7/1968. Every individual, including a salaried employee, can subscribe. So this PPF, Public Provident Fund, is started from 1st July 1968. Any individual and any salaried person can contribute towards this Public Provident Fund. Public Provident Fund scheme is activated under the Provident Fund Act 1968. Self-employed persons can contribute to the Public Provident Fund scheme. Yes, self-employed. If you are a self-employed, if you have your own business, then you can contribute towards the Provident Fund through Public Provident Fund scheme. Next, in this Provident Fund scheme, the minimum contribution is 500 per annum and maximum of 70,000. So in Public Provident Fund, the minimum contribution is 500 rupees per annum and the maximum is 70,000 per annum. Next, employee will get 8% interest per annum on contribution, and the maximum period of years is 15 years, and the maximum period is 15 years, this can be also extended. So max to max they can invest up to 15 years. After that they can extend it. So this is about public provident fund, where any person, any individual can go and contribute towards the provident fund scheme, even if he is a self-employed also, and the minimum contribution is 500 per annum and maximum is 70,000 per annum, and the interest given is 8% per annum, and the maximum duration is 15 years. So this is all about the provident fund. So with this, I'm going to wind up this session. So I'll meet you in the upcoming session with few more topics with respect to income from salary. So until then, thank you all. Have a nice day.